So what we'd like to do now, having taken a look at our balance sheet at 600,000, what we really are trying to do is evaluate the efficiency of how well he's running those assets, aren't we? And it was the sales that caused the need for the assets, so we're tracking those assets as a percentage of sales. We looked at where he is today at 600,000, then we went and projected what he would look like at 900,000, and what we learned was that 900,000, his sales have gone up, he's had some growth on his income statement, but what's happened to his balance sheet? It's deteriorated as we look at the current ratio, the quick ratio, and the debt to worth. That's right, those balance sheet ratios, they deteriorated. They aren't bad because he starts out really good, but he's growing weaker, isn't he? Relatively speaking, he's growing weaker. Absolutely, he's still pretty okay. Isn't that right? So that's where, and then we said now, he's got a real chance to grow. Instead of going to 900, what if he went to 1,000,006? He's going to like, go for it. And the question is, what would his balance sheet look like? And so you've spent some time working through that. Let's talk about this together and take a look at how this balance sheet at 1,000,006 would look. We're assuming he will be how efficient? The same as he was. Those percentages are still the same. What do you think? He goes from 600,000 to 1,000,006, almost tripling his sales. Is it really likely that he will maintain that same level of efficiency? I don't know. My gut would be if it goes one way or the other, which way is it going to go? Better or worse? Worse. Probably worse, wouldn't you think? Probably worse. At any rate, let's start there. We'll call that cut 1. And then if we need to fix it, we'll let him help us by managing this balance sheet more efficiently. So we said before we needed 2 steps. Number 1, we needed new net worth. A new net worth. He's starting still with 286, isn't he? This is 600 here, either 900 or 1,000,006. It's either or, it's not 3 years in a row. We could project it 3 years in a row, it'd just be a slightly different scenario, wouldn't it? So he's still making 3% profit after tax on sales of 1,000,006. How much does he make in profit?
48.
So when we go whack, how much is whacked? 48. We've got 286 is what we're beginning with. We add 48 more, and what's our new net worth?
334.
334. That was step 1. Now step 2, follow the road map. Follow the road map. And again, we're presuming he will be just as efficient as he was. So let's build it. 4% of 1,000,006. What'd you get, somebody?
64.
64. I'm just, again, dropping the 0 so we can get just whole numbers. 18% of 1,000,006 for receivables. 288. Inventory, 26%. For what?
416.
416. Current,
768.
768. 768. A quarter, 25% of 1,000,006.
400.
400. He's still got adequate capacity. I don't know about you, but this seems a little suspect to me. If he can triple his sales and still have adequate capacity, what does that building look like today? You could maybe drive a truck through it and not hit anything. I don't know. He's got some capacity there. Is it possible that sometime back during whenever the last recession was, he bought this building from somebody who couldn't pay the mortgage and he got a really good deal? And even though he bought more than he needed, he couldn't help it because that was the opportunity that came about at the time. Is that possible? I suppose it's possible. Anything is possible, right? Opportunities come along. One of the ideas about managing this balance sheet is being ready when those opportunities come along. Having a balance sheet that's ready, having debt capacity, having what? Cash. All those things help because you don't know when opportunities are going to show up, do you? Equipment of 400, land and building of 120. How much total fixed?
520.
520. Now, total current, total fixed.
1,002.
$1,288,000. Even at this bigger level of business, the balance sheet still has to what? Balance. You can't get it big enough so that it won't balance, can you? It doesn't matter how big it gets, well, unless you're the government, apparently. They can make it not balance. But everybody else, it's got to balance, huh? So what do we know has got to go here? If the assets are $1,288,000, liabilities and net worth need to be $1,288,000, don't they? Okay. So we've gone down buying the assets necessary to support the sales at this level of efficiency. Isn't that right? At his current level of efficiency. We're going across because the balance sheet has to balance. Now we're going to go up the other side, and we need to calculate the gap. So $1,288,000 minus $334, that's the net worth part. What's the new liabilities part?
$954.
9 what?
54.
954, okay. Now that becomes the total. Long term is still what?
140.
140. So if the total liabilities is 954 and the long term is 140, what does the current have to be?
814.
814. 814. And the accruals at 7%? 112. And the accounts payable at 15%? Who?
240.
Oh, 240, that's right. Okay, and the plug. Now what is the plug going to be?
462.
$462,000. In order for sales to go from $600,000 to $1,600,000 at this level of efficiency, he'll have to borrow an additional, what? $462,000. And I say additional because he's already got $140,000 borrowed, hasn't he? Is this a lot? And how do his ratios look? When we calculate his balance sheet ratios, it's still red, isn't it? It's still red. How do his ratios look? At $600,000, his current ratio was 2.18. Then at $900,000, it dropped to 1.33. At $1,600,000, 0.94. Quality of his balance, his ability to pay bills is doing what? Deteriorating. Quick ratio. This is pay bills. His ability to generate cash, what's it doing? It's deteriorating as well. For every dollar, let's put the quick ratio in words. For every dollar of what? Current liabilities, he's only got what? 43 cents of cash and accounts receivable. That's exactly right. It's gone from $1. It would go. He hasn't done this yet. He's still trying to kind of check out before he gets there and figure out what he might want to do. It'll go down. And his debt to worth, his risk, goes up a little and then what? Up a lot. For every dollar he's got in it, the creditors have how much? $2.86, isn't that right? $2.86. Who owns more of the rock? Creditors. And as we see his ratio going up, what's happening? If we write a sentence in here, if you write a sentence somewhere on your sheet to answer the question, what's going on? What would the sentence look like? Put it in the form of a trade-off. What is he trading off? He's growing, right? Growth on the P&L for debt or risk on the balance sheet. He's a bigger, riskier company, isn't that right? He's a bigger, riskier company. The question I have is he too risky? Is he too risky? Is this too much growth in a year? Now, I'm not trying to get you to say yes. Sounds like I am, maybe. Is this too much in a year? It depends. It depends on what? What does it depend on? Well, some of it depends on him, doesn't it? What will it look like inside this company during this year?
Chaos.
Sorry?
Chaos.
A situation of chaos. Do we tend to get more efficient under conditions of chaos? Not likely, huh? Not so much? So we would expect that those ratios might be optimistic. It could be what? Much worse. And this debt amount could be what?
Too low.
Could be higher. It could be higher. Assuming he can find what? A lender. Assuming he can find someone to loan it to him. I've got two companies. Both of them have the same picture. In the one company, my customer comes in and says, it's going to be a stretch, but here's the deal. We know that inventory and receivables are key to manage here, and here's our plan. And by the way, we know we're going to have to grow, but what we're doing is opening a second shift instead of adding space so that we'll use the same facilities. In other words, what's he telling me?
Being more efficient.
Pardon me?
He's being more efficient.
I can do this, and I've got a plan. And here's how I'm going to manage. I've identified what those key drivers are going to be, and here's my plan to manage them. It gives me some confidence. And by the way, the other thing I know, this person did this before. They've already done it with two other companies, and they've been successful. Now I have what? A track record. I have a comfort level that this is something that's been pulled off before. The other person comes in with this same company with a business plan built around the phrase, Yaha. We are gonna what? Go for it. I'm a little more nervous. Why? It doesn't appear that he knows anything about the road ahead. It doesn't appear that there's any vision of what might be a chuck hole and what might be a sinkhole. You can usually make it through a chuck hole. It's more difficult to make it through a sinkhole, isn't it? They just sort of open up and swallow things up if you happen to be there. And we don't want him to be a statistic. We'd rather have him be one of the 20% instead of one of the what? 80%. So what can he do? If you don't like what you see, what do you do? Yes, and if he misses his target, how will he look? Not so hot, huh? If you don't like what you see, what do you do? Change it. Be more efficient. Be more efficient. Well, isn't that one of those lovely things that people say? That sounds really good. Can you put any substance behind it? I actually developed a checklist. And if you will take a look in your case study materials, I've got a checklist of the action steps if you don't like what you see. This has come over the last 2 decades from my customers. And as you can see, I even created it in the form of a checklist, didn't I? Manage current assets. Which two? Which are the two that suck up money? The balance sheet does inhale. Inventory and receivables. In a growing company, or in a poorly managed growing company. It will suck harder, won't it? Manage those two things that turn. We've seen throughout this course the impact on cash flow of inventory and or receivables, haven't we? And we know that we can translate a day, a tenth of a turn, into what? Dollars. But the vast majority of the business community doesn't seem to be aware that this is a tool and that this is that action or the impact that those actions could have. Manage inventory and receivables. And as I said earlier, if you're in a service business, you don't have what? Inventory per se. You have inventory in the form of time. Manage that as well. If you happen to be a cash basis business, you have inventory but no receivables. Can this issue still happen? Of course. Restructure debt. On our $1.6 million scenario, all that $462,000 is put where? What kind of debt? It's right up at the top, so that makes it a current liability. So it's what kind of debt? Short term. If we move it south about 4 inches, we can take it from, and we've talked about this as well, short term to what? Does that change the amount of debt? No. What does it change? The cash flow implication of the repayment. Make more profit. Make more profit. Will that work? Will that work? It could. I was speaking once. I had done this program maybe 15 times instead of several thousand. I had done it enough to think, I'm pretty good. I've had all the questions asked to me that could ever be asked. So I went in there, and I love speaking at conferences. You get paid for a whole day, and you only have to work about an hour and a half, and that works great. I happened to be heading in. I figured I'll just whip in, do my, and this was at a time some years ago when everybody was focusing on growth. High inflation, borrow a lot of money and pay it back in cheaper dollars, all those kind of thinking. And everybody wanted to focus on, they said, we love that section on growth in your Profit Mastery program. Come and do that. So I got to about here and I said, is this too much growth? 700 people in the room. The lighting went back to where people actually disappeared. I couldn't see them back in the darkness. So I said, is this too much growth in a year? Expecting that people would say, yeah, Steve. So I hear this one voice go, I think that's a little conservative. Boy. I'd go to 3 million in sales. And I thought, oh my gosh. I said, if you went to 3 million, what kind of a number would you get there? And he said, a big one. And I said, no kidding, what would you do? And he said, well, it's simple. I always perk up when someone said it's simple. I said, good. Tell me. And he said, well, you're only showing making 3% profit after tax. I'd make 8% profit. That would eliminate your need to borrow. No one had ever asked me that before. So I'm sitting here going, okay. In my head, I had this conversation that says, okay, think. It's time to think. We need an answer here because everybody's sitting there going, this is a great idea. It sounds like it'd work. And what happened? Inside this little conversation I was having with, what was my brain saying back? This is too hard. I am shutting down. I am shutting down. And it was sort of like I was looking for somewhere to hide. And finally I came to that point where I had to what? I had to speak. So I said, well, gosh, don't stop at 8%. Let's make 20%. If we're going to smoke dope, let's get ripped here. I mean, what are the chances of making 8%? That's like almost tripling not your profits, but your rate of profits. And if you think back to math, that's like 9 times as much. You got to have what? A special situation that usually comes along how many times? Once in a lifetime. Think of a couple. That lady who died about 3 or 4 years ago, that 30 years ago, she invented this, she had this coiled wire that she didn't know what to do with. And so she put it together and it goes, boing, boing, boing. What was it?
Slinky.
A slinky. Everyone knows a slinky. Those kind of things. You know what I'm saying? They come along how often? Pretty regularly, but not apparently for us. These just don't come along very often, but the really interesting thing that sort of saved me here is I said, what if you could make 8% instead of 3%, as was suggested by the gentleman who was in my session? Would that, as he said, eliminate your need to borrow? That's the point. Well, we still need 1,288,000. Let's just do it. 8% of 1,000,006 is what? 8% of 1,000,006 is 128, I believe. So 128 and 286 is 414. That means that the liabilities would be 874. The current liabilities would be 734, and the plug, instead of being 462, would be 382. I said, golly, practically eliminates the need to borrow. Now instead of 400, you need 400. What's the point? Again, one of those myths out there. More sales will give me more cash. If I just make more profits, it'll be okay. Is more profits enough? It's not enough, is it? More profits is not enough here. What impact does more profits have? Relatively what? Relatively small. Is it possible in a rapidly growing company that even if it's well managed, turn in the inventory, turn in the receivables, using the fixed assets efficiently, even if it's well managed, can a company run out of money? And what happens then? What do we do then? We keep growing and crash and go broke. That's happened a lot. We read about rapidly growing companies and then bam, they fall off the edge. Or what else do? They've run out of their ability to generate capital. What do? What 3 letters? IPO. IPO. They go public to get people to do what? Give them money. Give them money. Here's $100 million. You can do anything you want with it. You never have to pay it back. You never have to pay back anything on it. You can do anything you want with it. What's that called? What have I just described?
.com.
I think I've just described Wall Street, haven't I? When we invest in a stock, do they ever have to pay it back? Can they do anything they want with it? Within reason. Sometimes that doesn't stop them. Yes, they can. We're betting on the come, aren't we? And we're betting on whom? People who can do stuff like this. That's who we're betting on, because they tend to be the ones we can count on. My checklist is not intended to be pick one. My checklist is intended to be, out of these choices, you build your plan, you build your plan, you build your plan, you build your plan. You're going to sit down with me, and this is going to be our capital, cash flow, how are we going to grow this business checklist. And I'm going to go through this with you and say, can we manage current assets better? By we, technically, I mean who? You. Well, we're going to compare you and do all the stuff we've learned to do in this course. And then we're going to set some goals. Because I want to loan money. If I'm the banker now, sitting in the banker's chair, I want to loan money to a business. If he won't do it, I'll save my money and loan it to who? Her, because she's proven she can do it, or she's willing to try. He says, I don't know, I don't like any goals like that. I say, great, go to another bank then, right? Someone who doesn't care. You want to work with me? I'd be happy to work with you. Manage current assets, restructure debt, move some of it down, make more profit, sell existing, and we know that more profit won't do the whole thing, but it's part of the plan maybe. We're going to put together a plan that will turn this balance sheet, if it's not something we want, into something we do want. Sell existing unproductive assets. What's the issue there? Who wants them? If they're unproductive for you, maybe they're unproductive for everyone, so you have to sell them sometimes to a bigger fool. Luckily, we can always find one. I'm told there's one born every minute. Curtail expansion. This is not often popular, is it? Stop growing. What do people think? What are you, nuts? You got to grow, man. My point is this. You can't grow if you can't what? Pay for it. If you can't pay for it, you can't grow. So we want to match those two up. These are not items that occur in a vacuum. We want to match them up. Lease instead of buy. Can we get people to help us? Our accountants can help us do a lease-buy analysis. Isn't that right? Sale, leaseback of existing fixed assets, meaning maybe you've got a fleet of trucks and you're out of money. What can you do? Sell them and lease them back. People say, well, what about the tax consequences? Cash flow is the primary consequence. Tax comes what? Later. Worrying about a good decision for taxes that turns out to be a bad business decision is in the end what? A bad business decision. Accept more risk. Now you've got your case study sheets laid out there at 600, 900, and $1.6 million. Maybe he could get a little riskier. Maybe, let's see, could we pick a risk level? His current risk level at 600,000 is what, 0.95? And then he went to 1.48, is that right? Well, maybe 2.86 is too much. Could you imagine in this process we just did, pick a risk level of 1.75 and work the thing backwards to get to a growth level that at this level of efficiency you could be comfortable with? It would be a bit of a difficult calculation, but we just do what engineers do, successive approximation. Pick a sales number that's somewhere in the middle and work it down, and if it's not right, it'll either be too high or too low. Pick a lower sales level or higher. I mean, you can eventually work it that way, couldn't you? The other thing to do would be to be more efficient. Drive those percentages. Which way? Up or down? If you're going to be more efficient, drive these percentages. Which way? Up or down? Do you want the percentage to get bigger or littler?
Smaller for receivables.
Smaller and smaller. We want them to get littler as a percentage of sales because it uses less what? Money. It uses less. It's less we have to spend. If we can reduce this by 50,000, get it down to, I don't know, 16%. Oh, by the way, why would we do that? Did you know that in your industry, the accounts receivable benchmark is 14? So I'm loaning you money to subsidize your inefficiency. I might be willing to do this if you'd be willing to agree to get your receivables down to 14%. Is that a doable thing? Well, first of all, in this business, if we can reduce it by 4%, what will that save us in cash? 1% of what? Sales. What's 1% of sales? It's $1,600,000. What's 1%? What's 2%? Okay, what's 4%? So if we can get it down to the industry, I created that in my head, but I mean, we could find an industry standard, and if it is 14, would we like to see him get his down to 14? Yeah, and how much would that save? 64,000. If the left side goes down 64,000, the right side's going to go down what? 64,000. It's pretty clear, isn't it? And where will it go down? Where will it go down? It'll go down either in accounts payable or note payable. We'll either borrow less from the vendors or borrow less from the bank, one or the other, or some combination of both. By the way, the inventory in your business, did you know the inventory average median is 20%? So you got 6% more. No wonder you need all that room. 6%, let's see, 6% of $1,600,000, how much is that? $100,000 you got tied up. So I'm loaning you $160-some thousand of that 462. That's due to what? The fact that you're what? A bozo. That you're inefficient. Is this unreal? So could I write those numbers right into the agreement as a covenant? Get it down to 14, get it down to 20. Could I write that in? What limits my ability to create covenants? My imagination. I hate to do this, but I'm doing it. We have those phrases that we all can finish, don't we? I'm doing it for your own good. Yeah. You're going, oh, just like my mother. Is it true? Yes, it is. I'm wanting you to step up and take responsibility. Don't grow. Well, like I said earlier, if you can't pay for it, you can't what? Grow, unless you want to grow and crash. If you do it big enough, then we could read about it, and you would get your fame. And finally, get new equity. Bring in what? Let me introduce you to our certified sugar daddy program. Find somebody with what? Big bucks. An ideal partner will have what qualities? Money. Oh, like retailing, location, 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 money, money, and money. Actually, they usually have a couple of other things that helps. Management experience, right? And maybe the most important thing of all. What's the hardest thing about selling? This is not a course on selling, but all of us sell every day in our life. What's the hardest thing about selling? Isn't it getting in the door? If you can play the game, if you've got good stuff, it doesn't matter if you can't get in the door. So what would the right partner bring you? What? Contacts. Isn't that an amazingly powerful thing that we can't really quantify? We can quantify it in terms of business, but we can't put it on a balance sheet. And a really good partner will have which of those three? Of money, management skills, and contacts? All of them. And really good partners usually aren't cheap, are they? Because they know they've got that. But that's the kind of thing that we might find. Now, what I'd like to do is just for a moment, in wrapping this up, I'd like to apply a couple of these concepts. Take one of the pages there of your case study that talks about, let's manage the inventory turnover, and actually let me demonstrate to you how it might turn out, okay? You can get rid of the $1,600,000 for now. I just want to use the 900. So 600 and 900 side by side, and then the page that says manage inventory turnover. So now you help me by calling out that, you got them? 600, 900, and the page that says manage inventory, selected options. So let's pick the one that says manage inventory. At 900,000 in sales, I'm making an assumption here that his cost of goods is 70. What's his gross profit margin therefore? If his cost of goods sold is 70, what's his gross margin? 30, exactly. So his cost of goods sold is 70 on 900,000 in sales. Just follow along with me here. The inventory turnover ratio, you remember, was cost of goods sold divided by inventory. 630,000 divided by what? 234 is what we calculated it to be, which will give me 2.7 turns per year. dividing 2.7 into 360 will give me how many days? 133 days. And I said, gosh, it sits there for a pretty long time. Suppose the standard in the industry was 4. If he could get 4 turns, that would be 90 days, wouldn't it? Now let's do what we did back in section 2. We'll take his cost of goods sold divided by the inventory turnover will give us his target inventory. Cost of goods sold, how much? 630. Target turns, not 2.7, but how many? 4 turns. He'd be carrying $157,000. What's he got in inventory on our case study? 234, isn't it? Instead of 157, how much would that save me? 157.5, technically. $76,000 in what? Cash that wouldn't be there. $76,000 by just turning it 1.3 turns faster. And if that's where the industry is, we ought to expect that anyway, don't you think? Now let's do this one more time. Let's look at receivables. And we'll do the same thing. His receivables, 900,000. All of his sales are on credit, so he's got 900,000 in credit sales. What did we project for receivables? Somebody on the 900,000 sheet. 162, giving us 5.6 turns. 5.6 turns on 360-day year is turning every 64 days. I'm collecting my receivables every 64 days. You with me on this? All right, now, let's suppose he could get it down to 45 days. That's an improvement of what? 20 days, 3 weeks. Well, we know 45 days is 8 turns. We divide it into 360. So we say, gosh, suppose I could get 360 divided by 45 is 8 turns. So now on his sales of 900,000, if I could get 8 turns, what would I be carrying? Anybody? 112,500, right? Instead of 162, he'd have 112, saving us roughly 49,500, roughly $50,000. Of what? Cash. Now I said, golly, let's do one more thing, because it's obvious that he's acquiring some fixed assets. So let's take a look and say, at 225,000, was that the equipment we projected at 900,000? Okay, that was 900. And what was his beginning equipment over on the 600,000 on the left there?
150.
150. So how much equipment between the 1 year and the next would he be buying? 75,000. And I said, well, let's presume that he put 20% down, like a deposit. Well, that's going to go away in that cash flow. And that'll leave how much? 20% of 75 is 15. So that'll leave the rest, which is 60. Since it's equipment, we'll make it what? Long term. Well, how much have we gotten long term on the 600,000 side? One what? 140. And we'll add 60 more. How much? 200. So now let's create what we'll call, I guess for lack of a better phrase, a managed balance sheet. A managed balance sheet. Let's just track through it for a moment and see what happens. He's still got cash of 36, but now receivables, instead of 162, they're what? 112. Inventory, instead of 234, it's what? 157. Total current, 306. Equipment is still 225, but we financed it differently, didn't we? We still got land and building, so we got 345 of fixed, but our total goes from 777 down to 651. He's doing the same level of sales, but he's doing it more efficiently, which means he buys less assets, which means he has fewer sources of money that he needs. He's going to make the same amount of profit, right? We're not going to drop his profit. He's just going to do it more efficiently. Actually, if he borrows less, we might see that profit number go what? Up. But we won't factor that in yet. That would be a second round of thinking. So his total liabilities would be, subtracting up the right-hand side, his total liabilities would be 338, 200 of long-term, 138, 63 of accruals, and instead of, didn't we figure 135 for accounts payable? Gosh, he only needs what? 75. So what could he do with the other 60? Well, let's see. We're showing him paying down his payables. He might get far enough that he could take what? Cash discounts. But if they don't offer cash discounts, then he might not pay it. He might say, I'm not going to pay you guys early. I'm going to keep it. Well, if he keeps it and doesn't pay them, it's still 135, and the 60 goes around, and since he didn't write a check for it, it's going to, instead of 36, he's going to have what? 96. You with me? If he doesn't pay the 60 out, it'll be sitting there in cash, and he's ready for what?
Opportunity.
Not a party. Well, a party. Yeah, you could do a party on 96. But he's ready for an opportunity. Maybe a party could be classified technically under opportunity, but he's ready, okay? He's got a stronger balance sheet, and he's managed it well. And he's ready for whatever comes along. Summary. With a managed balance sheet, he borrows what? Less or more? He borrows less. He makes the same amount of profit. He borrows less. He makes it more efficiently. You with me on this? We're talking cash. The roll, financial gap. What a powerful tool to help us figure out, A, how much we're going to need, and B, how to pay it back, and really help us focus on establishing some management parameters. This shrinks down considerably that area between borrower and lender. We're trying to work together. The lender provides capital. What do we provide? Management. By managing it efficiently, we can both win. It's as simple as that. It's a great tool. And when we get back together, we'll kind of summarize all of these tools and see how they go together in creating what? A plan. A comprehensive plan that we might want to present to whom? A lender? A partner? A potential buyer? Any of those. And we'll see how all of these pieces now we've looked at them independently, haven't we? But what we need to do now is integrate them together so that we can see the real power of how they all flow through. And when we get back together, we'll do just that.